Good day everyone, thank you for joining me. I'm Tamara Kukshinovich and I'm going to take you through the Woolworths EIA. In February, Woolworths released its interim results. The highlights were as follows. Group turnover and concession sales increased 5.3% to 43 billion rand. All divisional sales decreased except for food, which rose 10.9%. Gross profit rose 3% to 14.6 billion rand, and the gross profit margin reduced from 34.6% to 33.8%. Adjusted operating profit increased 14.5% to 3.9 billion rand, and the operating margin rose from 8.4% to 9.1%. Adjusted profit before tax improved 24.6% to 2.7 billion rand. Diluted EPS increased 75.1% to 284.3 cents, and adjusted diluted HEPS increased by 19.4% to 193.7 cents. The board decided not to declare an interim dividend due to the high level of uncertainty. Group interest-bearing debt decreased 11.7% to 15.1 billion rand. And net debt fell significantly by 41.7% to 6.8 billion rand, with South African net debt decreasing 19.8% and Australian net debt by 77.3%. The market reacted neutrally to the release of the results. The share price rose by 0.8%, closing at 47 Rand and 13 cents per share on the day. Since our neutral recommendation in September 2020, the share price has outperformed the benchmark with a return of 32.7%, while the benchmark, the capped Swix index, returned 19.7% over the same period. Year to date, the share price rose 21.9% and the benchmark 8.9%. FY21 earnings expectations have fallen. However, FY22 earnings expectations have risen, reflecting the high consumer confidence with the hope of successful rollouts of the vaccine and the subsequent resumption of the economy. Woolworths is trading at a 9.2% premium to its peers, compared with its 11.1% historical discount and a 16.6% premium to its 5-year average. Food remains the crown jewel of the business, with management believing further efficiencies can be achieved while remaining concerned about price perception. The fashion, beauty and home segment has the biggest potential upside, with the group focusing more on its internal brands. However, costs are high and we believe gross margins will be lower in the future. In terms of Country Road Group, management sees potential growth in the business. Still, we feel there is limited upside in growing the business online, and the group is continuously decreasing space. However, the separation of the Country Road Group and David Jones balance sheets was made possible through the sale and leaseback of the David Jones Elizabeth Street building, where the cross guarantee was eliminated and separate covenants were established. Additionally, interest-bearing borrowings fell significantly and are expected to fall further when the entire 510 million Australian dollars is received from the Elizabeth Street property sale. The sale of the two buildings has provided the group with more financial flexibility and de-risked the local businesses, as no South African entities are guaranteeing Country Road or David Jones. Still, two areas remain at risk, namely David Jones, with food still making losses, and fashion, which has continuously seen market share declines. Positively, management has implemented a new strategy to move away from formal wear, which should support sales. Hence, we retain a neutral view on the counter. If you'd like to place a trade, please speak to your financial advisor or contact the dealing desk. Additionally, the report on Woolworths can be found on the PSG online trading platform. But before we end off, please take note of the following disclaimer. Thank you.